Wage trends have been an important contributor to the persistence of inflation at higher levels. There are, however, indications of some moderation in average salaries and related unit labor costs, which are expected to remain below the 6% level over the forecast period. The outcome of a number of multi-year wage agreements that are due for renewal in 2017 will be closely watched, as they would pose a risk to the inflation trajectory. The persistent global oil supply glut, along with increased shale gas production in the US, have undermined efforts by OPEC and other producers to support prices through output restrictions. Since the beginning of June, Brent crude oil prices have traded at levels below $50 per barrel, and the bank's oil price assumptions have been revised down over the forecast period. This recent oil price trends, along with the stronger exchange rate, contributed to a 69% litre reduction in the petrol price in July. Following a weakening in the rand and a partial recovery in crude oil prices, a moderate petrol price increase is expected in August. The inflation outlook has improved significantly since the previous meeting of the MPC and has been fairly broad-based. The lower core inflation outlook is indicative of weaker underlying inflation pressures at a time when the impact of exogenous shocks on headline inflation has been dissipating. These shocks include drought-induced food price inflation and, to a lesser extent, international oil price increases earlier this year that have since been reversed. A number of risks to the inflation outlook persist, and the MPC assesses the risks to the inflation outlook to be broadly balanced. Although the rand has been relatively resilient, it remains vulnerable to heightened political uncertainty, global monetary policy developments, and possible further credit ratings downgrades. On the positive side, it is supported by a sustained narrowing of the current account deficit and positive investor sentiment toward emerging markets. A further upside risk relates to the possible supply-side shock of a large electricity tariff increase from July next year. Eskom has approached NERSA for an increase of around 20%, but the current forecast assumes an increase of 8%. This assumption will be adjusted in line with any new determinations made by NERSA. The MPC remains concerned that inflation expectations remain sticky at the upper end of the range. To the extent that these expectations are formed adaptively, they should adjust downwards if the lower inflation trajectory is sustained. The MPC would prefer expectations to be anchored closer to the midpoint of the target range. Underlying demand in the economy is extremely weak, and the MPC is concerned about the deterioration in the growth outlook over the forecast period. This decline is broad-based. It is unclear where the drivers of accelerated growth will come from, in the absence of credible structural initiatives that will reduce uncertainty and increase business and consumer confidence. The MPC assesses the risks to the revised growth forecast to be slightly on the downside. Given the improved inflation outlook and the deteriorated growth outlook, the MPC has decided to reduce the repurchase rate by 25 basis points with effect from the 21st of July 2017 to 6.75% per annum. 4 members preferred a reduction, whilst 2 members preferred an unchanged stance. As we have emphasized on numerous occasions, the MPC does not view monetary policy as the solution to the structural growth constraints in the economy, nor does it believe that a reduction in interest rates will provide a significant stimulus to growth in the current environment of low confidence and political uncertainty. It will, however, provide some relief at the margin. In this highly uncertain environment, Future policy decisions will be dependent on data outcomes and our assessment of the balance of risks. We remain vigilant and would not hesitate to reverse this decision should the inflation outlook and risks deteriorate. Thank you very much, ladies and gentlemen. Let us now turn to the questions, and as usual, please identify yourself and the media house that you